Good morning and welcome to the Saxo Bank Morning Call. It is Tuesday, February 5th, 2019, and I'll tell you, we have markets in a very positive mood, whether looking at high credit, EM, and stock markets, of course, as well. Overnight, the big mover was the Australian dollar. An awful lot going on in Australia overnight. We had economic data all pointing down, retail sales and other data. And yet the RBA insisted on keeping a rather optimistic growth forecast of 3%, down from 3.5% the previous forecast, although it did lower its inflation outlook. If we look at the chart here on Aussie dollar, we saw it dipping lower initially on that bad economic data and then rebounding quite robustly. I think we need to be careful about where we point the blame for this reaction. I think a lot of the reaction to the upside was about the outcome of this Royal Commission looking at a number of things, but basically coming out much softer on banks than was feared. We're talking about things like vertical integration, whether banks can continue to sell the products that they themselves package. There was no big adjustment to restrictions on lending standards. I've got an example here on the chart for the West Bank banking core, the banking sector across the board up around 5%. So we're talking about quite a reaction in these big equities, and these are very big equities for the local market in percentage terms. Mortgage brokers, however, it looks like they will be shut down over time, and these were a big participant in the whole lending frenzy into the housing bubble. The question is from here, and I think before we sort of take everything at face value, is whether the already existing declines in the U.S. or in the Australian housing bubble are going to already reinforce banks' own decisions about tightening lending standards in this so-called doom loop of the typical credit crunch once the asset markets start coming down. So, initially, if we look at that Aussie dollar chart again, if we close the day around here or higher, we've got that 200-day moving average coming in. Certainly the shorts don't have much of a case. We need to see that price action for Aussie dollar headed back and closing below 72 before we have a better technical case for the bearish side. Otherwise, we risk a further bear squeeze higher before and have to look for selling from higher levels. I still think in the longer term, looking for ways to play the Australian dollar to the downside. Elsewhere in FX markets, yesterday, dollar yen poking at that 110 resistance level. This is a big one. We're seeing U.S. yields rebounding. Of course, risk appetite, as we mentioned earlier, we'll talk about Altea as well with the corporate bond market, just flashing green across the board. So you see in yen crosses and even dollar yen, I have a chart here showing that 110 level in play yesterday. It did not take it out on the initial approach. I think we've got with these U.S. Treasury auctions coming up all week. I'll be looking at with the direction for dollar yen in U.S. yields. I'll tell you though, your focus, we have these big treasury auctions this week, and I don't know if you have a comment there, but certainly one of your focus points is on the Chinese government bonds, where yields continue to come in lower.
Yes, exactly. So we have a graph here that shows that Chinese government bonds from November 2017 until now, basically losing around 100 basis points on the yields. So from 4% to 3% in yield on the 10 years. And here you cannot see that, John, but the yield curve of Chinese government bonds has been steepening. And what we have seen has been a bull steepening, where the short-term part of the yield has been rallying faster than the longer part of the yield curve. So many investors now, they're wondering, is this rally over? Are we going to see a widening? And I believe that there is still reason to believe that Chinese government bond will continue the rally. And the reason is going to be mainly the policies of the People's Bank of China, which, as we know, is going to do anything that it can in order to support the economy.
Great. And then if we look at the U.S. Treasury yields here, or this is actually not the yields, I have the price of the 10-year future. Just wanted to point out, we saw quite a big move on Friday. Some may have tried to link that to the U.S. data. I think that's partially justified, as we did see the nothing threatening, particularly threatening in the U.S. jobs report. The ISM manufacturing came in strong. We have the ISM non-manufacturing up today, but that big reversal there suggests maybe we have the tops in. Could come in lower if these auctions are weak, and then you have the interesting dilemma. What is the market supposed to do with U.S. Treasuries? The whole idea is that a softer Fed has been encouraging a comeback in risk appetite, but if U.S. yields come up too high, too fast, it begins to push the other way, and then the market begins to fear what the implications are for higher U.S. yields. So I think an interesting thing to watch there in the trade-off. And then, of course, with these, with this strong risk appetite, we're seeing quite a strong emerging market complex. Here we have the Turkish CPI numbers. resume rising. What are we showing here?
Here we are showing actually the 10 years Turkish government bonds in Turkish lira. So the news here is that we have seen last month an increase of CPI after 2 months in November and December where we have seen the inflation, Turkish inflation falling. So what does that mean? Like as we know, last year the central bank has been easing, although we had an increase, we had a lot of volatility in the Turkish lira. And the real question is here, will the central bank will continue to be dovish, or at this point we need to look at...
Usually when you have an emerging market bank and they're starting to cut again, it's because there's sort of relief. Now the currency has stopped devaluing. Maybe there's some relief on that front. But now you're saying the CPI numbers coming up.
Yeah,
and
exactly.
The risk is, can they take that step if those CPI
But the real risk is here is that, as you can see in the graph, the Turkish lira government bonds have been one of the highest yieldings among the emerging market bonds, and from 21% in August last year, they rallied basically down to 13.8%. And the real question is, the rally is going to continue. I believe that is going to be unlikely, and I believe that Turkey might be the catalyst to start another scene of volatility within the emerging market at this point.
That would fit with a general turnaround in risk appetite, which we're not seeing yet. But to be fair, obviously with a trade like that, the risk reward is certainly a very dramatically different place than it was when those 10 years were yielding 20%. Just to point out briefly, we're at a big technical inflection point on risk appetite if we use the S&P 500 as our global benchmark. We passed above the 61.8% retracement. I have the chart here, and we're heading towards that big 200-day moving average. Pretty key stuff. Although if you look back in October through December, that moving average was crisscrossed a few times. It was took some time to decide which way it wanted to fall. So it doesn't necessarily a hard resistance level, just one to keep an eye on. And we've just seen a dramatic continued resurgence in equity markets. And then on the earnings calendar, I'll feed right into that. And actually, speaking of 200-day moving averages, we have the Disney stock at around that 200-day moving average. Much more clear sort of focus on that ahead of earnings today. Of course, they're about to launch their streaming service, and the market's anticipation around that is rather interesting. On a side note, I'm noticing I had a glance over at Netflix after seeing a headline yesterday speculating that Apple might be interested in buying Netflix, something to do with its cash hoard, and get in on this whole content side of things. Interesting idea anyway, but watching that equity as well over this whole issue of streaming. You would think Netflix may be threatened by a big new rival in the streaming space. We had BP out this morning with at least the headline that I saw showing a very strong result. Daimler, very interesting tomorrow with their outlook, given the weakness in the German car sector and fears that a German recession could be up and coming. And I'll tell you, we talked a little bit earlier before the broadcast. I mean, we're seeing this risk appetite. Often you look for other places where maybe it's turning around first. Certainly not turning in the high yield space in corporate bonds.
Yes, what we have seen throughout all January this year is that credit spreads have been tightening quite dramatically, and I'm not surprised. And the reason is that last year we have seen a widening of credit spreads, and this year we started with a recovery of the equity market, and we started also with a Fed that sounds dovish.
The big dovish pivot, yeah.
And this means that bonds are going to be supported, and it's not surprising to see bond investors to go and try to take advantage of this situation.
So still seeing those credit spreads compressing on the dovish shift from the Fed. We've got a busy economic calendar today for on the macro. Actually, not so much today, but just the rest of the week. We do have the first of these auctions. It's only for 3-year debt. Maybe more interesting to see the 10-year and 30-year auctions tomorrow and Thursday, respectively. Do keep in mind Chinese markets offline for the remainder of this week. We have the refresher on the Eurozone services PMIs for January. We already got to look at the flash numbers, dipping to 50.8 on the flash estimate. So we're getting close to that recessionary territory there. The ISM non-manufacturing expected, I'm actually not quite sure I remember where it's expected, but it was at 57.4 still expanding at a strong pace back in December. We'll look for that as well. And then the rest of the week, again, those U.S. auctions and and Bank of England, which I don't think is terribly relevant given all the unknowns in the whole Brexit process. I think that's a wrap for today. We will be back tomorrow with the Saxo Bank Morning Call. Thanks for joining.